This is a promotional podcast for EIS Platforms Limited trading as Growth Invest. Any comments made or opinions expressed in this podcast should not be construed as investment advice or a financial promotion. Startups and early stage businesses are high risk investments and you are unlikely to be protected if something goes wrong. Don't invest unless you're prepared to lose all your money.
Hello and welcome to the Alternative Thinking Podcast with me, Melissa Griffiths and Steve Dobson, the podcast that takes a deeper dive into the alternatives marketplace and exploring topical issues. Today's focus, the imminent tax year end, with our guest Paul Mattick from Mercia and Northern VCTs and Nick Priest from Downing.
Hello.
So
Mel,
boys.
can I just butt in, please, there?
Yes.
Can we not first start talking about the rugby from the weekend, England-Ireland? Guys, what have you got to say on this?
It's never in doubt.
I have to disagree. It was kind of era back to Johnny Wilkinson, wasn't it? That drop goal.
How good was that drop goal?
Yeah, that was fantastic. In the pocket, perfect timing.
How long have we got to talk about the rugby, Mel? Are we okay?
Well, it wasn't exactly the aim of the game.
Okay.
We have a lot of things to tackle.
Fine.
But yeah,
Like
Well
yeah,
done,
yeah, I'm on it. Right, so let's move on. But tax year end. Okay, so it's rapidly approaching. With you guys here, we can talk VCTs, IHT, both asset-backed and AIM, EIS funds, knowledge intensive, and obviously we've got our guru, Steve, to give us a bit of market intel as well. So
I can try.
Right, so I'm going to start with you, Steve. Well, VCTs, what's the sort of current update?
Right, VCTs as we stand, we are just over 600 million, 620 million, I think, for the year to date, which tracking, we think it's obviously slower and lower than last year. Last year is a tax raise, and the tax year it was just over $1 billion. We think it's going to track to around about 700 to 800 million this year, which Paul, obviously you're in the VCT game. You've probably seen similar. I mean, your fund is about to close or nearly close. Looking at the industry as a whole, every company that has announced an RNS to raise has opened. They're now starting to close. The popular VCTs, as I said, the Northern VCTs is just about to close. But, you know, it's been slower in the VCT space.
And I mean, I think Titan as well has been a lot slower, hasn't it?
Yeah, and a smaller target raise
as well.
And a
smaller target raise, yeah. So, I mean, I think the general feeling is it's not going to be a record-breaking
No, it'll still
season.
be good. It's still probably going to be, third highest ever, but...
Yeah, which I think everyone needs to realise in a climate that is pretty negative at the moment anyway. So, I mean, it's still...
I will jump in here because I think it's about return to the normal. Because the last couple of tax years have been kind of hype post-COVID. Like the VC was flying across the globe and the VCT market was over $1 billion. Previous tax years, kind of 650, 700 was the max.
Yeah.
And we'll probably be there or thereabouts, maybe 750. So I think it's actually a pretty good year with the context of back to the normal. And we have seen a big downtick in the amount of EIS and VCT. And I think this is kind of the start of the new normal. So I think we're into the new era of EIS and VCT fundraisers, and this is the kind of the baseline. And I think it's a good baseline. But you can see, yes, some of the big VCTs are down, but there's other large offers. Like we never raised more than 40 million, and we're just closing out at 60 on Northern VCTs, and British smaller companies with their 90. So there are some decent size offers out there, but the demand is not as strong as it has been the last couple of years, from my perspective.
Yeah, and I mean, from what we've seen on the platform, there has also been like Unicorn AIM VCT did move quite quickly. It hasn't been like the Mobius of the year before, and we didn't have a Marty AIM come out this year, which is some of the more fast moving. But my feeling is next season, I think we could see it speeding up again as well. But I mean, that would be interesting. We can talk that later. I was going to do predictions. But
well, you also can't discount interest rates at the moment. So people may be delaying coming into VCTs until the end of the tax year, get an extra few £100 in interest, which is a 4 or 5% interest on bank accounts. That is relevant at this stage.
Yeah, and tax-free dividends as well is something I think, you know, we constantly keep seeing the allowance being cut on dividends. So, I mean, that's another advantage, isn't there? VCTs, to me, are becoming an alternative to a pension fund, strong income coming back from the dividends and special dividends. I saw a lot of special dividends coming out over the season as well, which is good. Nick, you're looking at me like you might say something.
That's just how I look. Always look like I'm about to say something. No, I think that I agree with Paul on the sort of the rebasing, and this is the starting point, and probably will grow, I think, year on year from here again. I guess if you look and you hear everywhere you go, we have a cost of living crisis and nobody's got any money.
Yeah.
It doesn't matter whether you've actually got some money or not. You could feel like you haven't got any money even if you do, and so it sort of makes sense. And the thing about VCTs obviously is that this is a year on year allowance, so you can take a year out and then come back to it the following year, and nothing's really changed that much. So that might be a little bit what some people would do. So that would attribute some of the lower fundraising as well.
Yeah. Okay, let's move on to inheritance tax. Obviously, I'm looking at you, Nick. So there was talk of record-breaking year for inheritance tax receipts. April 23 to January 24 was hitting 6.3 billion. There's always talk about the huge intergenerational wealth transfer as well of 5.5 trillion over the next 30 years. Let's look into the IHT market a bit more. We are seeing a lot of rights issues across the marketplace. Can you elaborate a bit more on this, Nick, for us?
Yeah. Okay. Well, I can tell you sort of from Downing's perspective, really why we think of it. And actually, the answer is it depends who you ask as to why we would do one. Just on your point there about the transference of wealth and the 5.5 trillion, about 75% of that I think is the baby boomers, and the youngest baby boomer is now 60. So this is a real planning. It's a real moment for your advisor base to be getting involved with those kind of clients. Yeah, so that's a really big deal. In terms of the rights issues, well, let's start with the client, the shareholder. It was pretty obvious what's in it for them. If they've been invested for 2 years and they've qualified already for business relief, and they take out an additional subscription and a rights issue, then they get that qualification straight away. So they can get whatever money sitting around that they haven't made decisions or accumulated in that time. They can not get it outside their estate because business relief is inside your estate, but they can get it nil rated very quickly. So starting there and working your way back. So you've got the shareholder, and then the next point of call would be, who looks after the shareholders? Well, so you'd think the independent boards. So the independent boards are looking at the shareholders and say, well, the tax side of it's good for them. Then what else is important to them? And that's diversification, and then it's liquidity. So those are the things about business relief. You'd say, well, one of the reasons people use business relief for inheritance tax planning is be able to access and have control and access, not give money away. So liquidity, if you might want it back again, that's really important. So the bigger these services are, the better for the shareholder. The greater diversification means you're not putting all your eggs in one basket. So that's that. So working your way back from there. Downing's a B Corp, so a lot of the things that we do in there on the asset-backed side and energy infrastructure in the unlisted markets, a lot of that is around making impact. So we're helping businesses like water utilities who are very carbon intensive. We're building solar on water utilities to decarbonize their output. So these are impacts where you can say, well, at the beginning there was this much carbon output, and this is a utility company, so it's necessary. And here at the end of it, we've reduced that to zero. And that in terms of the government's net zero targets, that's really important as well. So then, you talk to Roger, who's our head of sustainability, you say, well, that's why a rights issue is really good, because it brings in a big chunk of money in one go. And then, from the investment side of things, well, we have a large Downing have, and I think I can speak on behalf of all the ITS services. You spend all your time doing due diligence on businesses, building up a pipeline of businesses, and one big slug of money coming in allows you to invest into those. And some of them you can draw down on bit by bit, and some of those deals are really good deals. You might need to pony up some cash straight away, and the rights issue helps you do that. Whereas
so you think it's a trend, Nick, that's going to sort of keep going across the marketplace?
Yeah, I mean, I think you have to be a little bit careful. This is my own personal opinion. So if you do it every 2 years, that kind of makes sense because that aligns with a qualification period. I think if you're seeing rights issues every year, I don't know whether that's particularly wise, but but that's, I think, the benefits all round that I've just mentioned. You can see why they're popular, and for advisors, all those benefits, they all stack up. So.
Okay, well let's watch then, see whether it is a recurring seasonal kind of thing, or whether it maybe.
I think they're becoming a lot more common. Yeah.
Yeah.
There's a lot more recently. You've seen different
we've
names
seen,
doing it.
yes,
How
across
does
the
that tie
marketplace.
in, do you think, with the whole consumer duty and diversification? Because obviously you're putting more into the same, so that could be the contra argument, I guess, to the points you've made there. What do you get any feedback on that?
Yeah, well, actually, that is a good point that I hadn't actually really thought of, but it's a good point. And actually, I think that some of the relationships we have with the larger wealth managers actually shows them considering consumer duty in real time around rights issues, where we've had some businesses who have committed to a rights issue with us and then committed to somebody else's rights issue, and they have allocation policies. So they'll say, you want to split it between 3 or 4 or 5 managers, and if they committed to a Downing inheritance tax rights issue a couple of years ago, then they say, well, look, do the other one so we can balance it all back out again. So I guess that's them thinking about diversification and consumer duty in all in one. Well, I hadn't really thought of it like that, but yeah.
I didn't mean to put you on the spot there.
No, it's good actually. It sort of answers a question.
Okay, we're going to kind of move on. In looking, we've got asset-backed and AIM. Steve, do you want to sort of run through where you feel AIM marketplace is at the moment?
Yeah, I mean, obviously you can't give investment advice, but we're in the cycle. And, post-COVID, AIM, like all of the major indices, dropped off a lot. AIM more so because it's a lot more volatile because it's smaller companies. But then it rallied back a lot more too. And then we're kind of almost half from the peak in 21 to where we are today. So is that an entry point? You could say, yes, it is. But it's, with inheritance tax, along with all the other topics we're discussing here, it's an investment. So you're looking at it over the long term. So you've got to almost iron out these cycles. It happens in industry. We see it in the marketplace. So is it a good time to get in? It's impossible to say. This is everyone's, judgment call, and advisors, that's what they're paid to do. But ultimately, if you liked AIM into 2021, well, it's a better entry point today.
Yeah.
That's the best way of looking at it, I think.
And are you seeing a preference from the client base to either AIM or asset-backed at the moment?
I mean, this is going to be a shameless Downing plug.
Which
Another
we're not
one.
meant to be doing. Well, don't worry. Paul's about to come on soon, so he's going to
It's going to be his go,
revenge.
right? Yeah. It's heckling me for them. But yeah, I mean, we're doing quite well in both, really, at the moment. Performance-wise, doing pretty well in both. So we're seeing lots of inflows. I mean, firstly, there are more AIM IHT managers that are unlisted.
Yes.
So, there's a lot more to go at there in terms of, if you're an advisor putting money into it, there's a lot more to choose from, which is a complication in itself because it's quite a
And one
complex
thing
market.
I find is that when you actually look at a lot of the AIM IHT products, you're all in quite a lot of similar companies.
Yeah, well,
And-
so there's broadly kind of two approaches to AIM IHT investing, and that's kind of value versus growth. It's a value versus growth story, and a lot of the growth manager will be in similar stocks, and the reason for that is because there's a small number of them. I think there's circa
That are qualifying.
Yeah, well, there's circa 800 AIM companies. I think really across the board, whether you're a growth manager or a value manager in AIM, AIM is absolutely the place where stock picking is important because it's a bit of a wild west, and understanding the companies and getting sort of really into the detail with them is really important. But actually, we're a little bit different in terms of the way we invest. We invest further down the market cap. But actually, I think this period of time, and you're talking, Steve, about the volatility in the AIM index, this period of time really should be dictating to advisors about how they invest in AIM for IHT. They should be investing in growth managers, and they should be investing in value managers. And I only bring this point up because when we talk to large businesses, wealth managers, they don't seem to treat that in the same AIM IHT investing in the same way they would do a normal portfolio. And actually, yeah, you're right. You could be right. There could be great opportunities in a growth market, and this could be the bottom, or there could be a whole lot further to go. And actually, you need to be covering both bases. It's easy for me to say that now than it was before because we're sort of the tortoise and the hare and the tortoise story, right? We're just winning that race, but it's still the same thing applies, right?
Hindsight's always a good thing to have.
Right? Right now it is.
Okay. I'm thinking now we've done a bit on IHT. What about EIS? And
it's your plugging point here.
Yeah, this
There you go.
this is for you now, Paul.
Fantastic.
So EIS and knowledge intensive funds.
Yeah.
Mercia has both. Can you describe the difference?
Yeah, well,
pros and cons?
Knowledge intensive is, I think, very much misunderstood, and probably not enough people, advisors, recognise the benefits. Because EIS, yes, we all know 30% income tax, CGT deferral, IHT, nil rate, fine. But the administration of EIS portfolios can be quite challenging. And planning tax year end and trying to work out when you can claim income tax across which year. And knowledge intensive simplifies this all. So rather than being a complex kind of investment, it's much more simple in that you get one tax certificate and you are guaranteed when the income tax relief can be taken. So any EIS, knowledge intensive EIS fund closing in this tax year, I'll close on the 5th of April. So this tax year just means that you can carry back to the previous tax year, so back to 22, 23. So you can almost carry back 24 months for income tax purposes. So there's a long period of carry back. And this is especially useful when you're trying to manage capital gains. So if you imagine that you had a big capital gain, you want to defer as much as possible, and you're matching against the income tax which is being paid, you can add an extra tax year into your income tax planning to reduce the CGT as much as possible. Getting quite complex quite quickly then.
Yeah.
But that's from the client and the IFA perspective. So that's kind of the reason that knowledge intensive exists is effectively it's a subset of EIS companies which the government wants to support even further. So lots of R&D and or knowledgeable workforce, and if they qualify for knowledge intensive, it's an addition to EIS, and it not only does it have this guaranteed deployment date effectively, also doubles your max from 1 million up to 2 million per year. And actually that takes it into a new type of client, and we're seeing more people who are selling businesses, doing big EISs and actually family offices as well. So it's the kind of the top end clients who advisors might be working with who actually find these knowledge intensive funds is particularly interesting because they can actually move the dial on their big tax problems. So that's the knowledge intensive element, and that specifically is around the income tax reliefs. For CGT and IHT, knowledge intensive is exactly the same as a normal EIS. And I think there's room in the market for both knowledge intensive and normal EISs. And that's kind of what we see. The two will go in parallel, I would say, going forward. I think there has been a progressive move towards knowledge intensive, but I also think there is significant space in the market through the rest of the year, kind of the April to December, for normal structures, so they're actually called unapproved EIS fund structures.
So you don't see knowledge intensive replacing. I mean, we know from the platform there's an advantage with the knowledge intensive in the single EIS 5. I describe it, because I'm quite simple, I describe it more as a sort of cash flow for clients, because sometimes it can take up to 18 months for deployment. I think it's 90%, is that right?
Yep.
Deployment to receive the EIS 5, and it's only when you receive your EIS 5 that you can then apply for your income tax relief. So there is a bit of a delay. I think more and more knowledge-intensive funds are looking for a shorter deployment timescale. But yes, for the management of the EIS funds, it's a huge advantage, isn't it?
Yeah, definitely. And just a little plug, we're deploying within 6 months for our knowledge-intensive EIS.
Oh, right. Okay, one of the more
There you go.
speedy ones. Yeah,
That's just to the scale of
let
Mercia.
Nick have one.
There
So
we
you can have
go.
one.
Touche. But no, it's right. There is marginally impaired cash flow because rather than getting, say, 12, say 10 EIS 3s, where you could submit each one at a time, you get one EIS 5, which you submit at the end. What people tend to do with EIS portfolios anyway is they hold on all the tax certificates until the end and submit them all together anyway.
Yeah.
So on that basis, it's no different at all. But if people want these very incremental gains of marginally an extra month on the income tax relief, yes, you can't get that. But I think the simplicity with administration is much better with knowledge intensive, especially if you're diversifying across, say, 2 or 3 managers. So rather than getting 25, 30, 40 EIS 3s, you get 3. EIS 5s.
Isn't a massive problem on the Growth Invest platform because we have all the EIS 3s and EIS 5s.
Everyone's getting a plug-in now,
yes,
aren't they?
Exactly. I was going to say, we might as well go for it. But yes, but no, I mean, it is going to be, I think, a game changer for large wealth managers, particularly, I think, with numerous high net worth clients wanting to do knowledge intensive. It makes it so much
the
simpler.
platform or the ES5? And
I think that, yes, both. The EIS5 and, of course, the platform.
Yeah.
But, right, okay, so that's sort of... and do you see a trend more... You haven't seen a trend in more into knowledge intensive at Mercia?
It's quite hard to tell at the moment. Other growth stories, so I would say it's probably the same amount of non-EIS as we have, non-knowledge intensive EIS as we had before, and then knowledge intensive on top of that. And you're seeing more and more knowledge intensive offerings coming out to the market, which, and I do think this time of year it is going to be very popular. Partly because you're not compromising how you're deploying capital, because you can just throw money at companies at this time of year and get it deployed before tax year end. But personally, I don't think that's optimal. But,
No.
Yeah.
Okay. Let's look at our thoughts for next season. Let's go into a bit of predictions. So who wants to kick off on this one?
Predictions for next tax season.
How do you see...
Mel was still talking about the rugby, weren't you?
Yeah, well, one game to go. Next tax season, well, I guess given so much of the activity takes place in the final quarter of the tax year, at that point, UK election theoretically should have been done, US election will be done. So I think there'll be a lot more surety around the environment in terms of where things are heading towards. We expect interest rates to be lower, inflation to be lower, more incentive background for people to invest. So I think we'll see a pickup, I think, is my view, across the board. I think there's new product coming to market, not necessarily tax efficient, but things like LTAFs, long-term asset funds, I think are going to come into play, a lot more focus on those. So I think more of the same, but on a positive trajectory.
Okay.
Yeah, and I generally agree with that, because I think I mentioned before about the hype cycle in 21-22 being so, post-COVID exuberance, and now we're back to reality. And I think we are on an upward trajectory from here, I would say. We're bottom of the big macro cycle. So I'd say we might see 800-900 million into VCTs, and I think the EIS market will also grow. But that's kind of where I see in terms of the broader scope of things.
Yep. I can't disagree with any of that. And I think, more specifically about inheritance tax, a bit of certainty, the noise quietening down. I think a slight normalization, if you like, on interest rates means that 2024 should probably be a bit better than 2023, where a lot of people would be, certainly in the unquoted side, in the unquoted IHT, a lot of sitting on hands in terms of sales as well as getting deals done. So yeah, it's starting to look a little easier already. So deals out and deals in both becoming a little bit easier. So that's it's got to be a positive for deployment.
Yeah. I mean, for me, I think, as I mentioned, I think the VCT market will be strong again and a bit faster. I think I quite like when it's a bit faster, but I think we will see a bit more of a faster closing and quicker movement. EIS, I'm beginning to hear across the market there's more exits being expected, and hopefully with that will start encouraging people back into the marketplace, which would be great as well. But let's see if any of us are right. We'll have to all sit back here this time next year.
Is that a plan?
It's a date.
It's a date, exactly. So with that, let's wrap up. Thank you to both Nick and Paul. And yes, let's wait for our next Alternative Thinking.
Thank you, guys.